Very popular session today. I think maybe it's because everyone's in lockdown. So, you know, they've got lunchtime entertainment, I guess.
Lunchtime entertainment, no pressure. Okay, so we'll make a start now. So welcome everyone to our webinar for using your super to buy property. This is a topic that we are really excited about to present to you today. Using your super to buy property can be a really fantastic way to grow your wealth in a really tax effective manner. So we're really excited to present this today and hopefully provide some education and make everyone aware of the opportunity. Before I introduce the panelists today, I'll just want to go through a bit of housekeeping. I'm sure we're all very used to Zoom now and all experts on Zoom, but if any questions you've got, if you can chuck them in the Q&A rather than the chat, just makes it easier to manage and make sure that we don't lose your question. So today on this webinar, we have the founder and director of Smart Business Solutions, Shannon Smith. Many of you will obviously be well aware of Shannon and her keen interest in property investment. Also speaking today will be myself. I have over 13 years experience in advising SMSFs, so self-managed super funds, and I spent nine of those years as an SMSF auditor, ensuring that our clients maintained their superannuation fund that kept them out of trouble with the ATO and anyone else that wants to have a go at them. So also with us today is Carly Davin. Now Carly joined us in January with over 15 years experience in mortgage broking. So we decided to add mortgage broking as a service within Smart Business Solutions to ensure that we offered a full range of service to our clients to help them grow their wealth. As accountants, we particularly find that we can help help clients with their SMSF lending better than other mortgage brokers because we understand the structures and we can advise on the specifics around SMSF lending. Thank you, and I'll hand it over to Shannon.
Great, thanks Paul, and thanks everyone for joining us today. And this topic is one that's very close to my heart. I'm a big fan of property investment, as Vivian had put out in our marketing material. Using the SMSF might be a good way of feeding that property addiction that you may have, or that enjoyment with property. So having the opportunity of feeding that kind of property love for property, and then also putting in an SMSF to be able to grow your wealth overall is something that I'm very passionate about, really enjoy, and happy to share that enjoyment with all of you. So what I want to cover today, a bit about SMSF property investment, what it means, what are some of the structure options, and I'll go through some of those different aspects because it may or may not be relevant for your situation. What is SMSF borrowing? So Paul's going to take us through what is the SMSF borrowing and how can you use that also to your advantage. What are some of the types of properties that an SMSF can invest in? And then how do you deal with related parties? Because that can be a potential issue, as Paul, the ex-auditor, will tell you. And then also it isn't a one size fits all, which I think that actually adds to the benefit of it all as well. So starting off, SMSF property investment, this is something that has absolutely taken off over the last number of years, and I'd probably say more so over the last 5 to 10 years. I actually was looking for some stats out there and actually having a look and seeing how much SMSFs are now investing in what we call real property. So not property through, I guess, managed funds or shares, etc., but real property being, the property down the road, the offices, etc., and the growth that you're seeing. And so this is just actually over the last 5 years to actually show you the period of how much that has grown, and then also how much from a debt perspective and where the SMSFs are actually investing in property, getting access to the borrowing, which Paul will go over in more detail soon, which is not something that's been around forever, and being able to really build their wealth on that. So it's really quite a topical situation. So why invest in property through super, and what are some of the benefits, and why are people doing it to increase their wealth? One really, really big aspect is income tax efficiencies. So you've got not only the efficiencies today, but also at retirement. So what have we got today? Today, your self-managed super fund, they're taxed at 15% tax on any investment income while you're in what we call accumulation phase. So you have income, whether it be rental income, etc., in the SMSF. Sometimes when you've actually purchased a property, you may be in what we call a negative gearing situation where you've actually got a lot of expenses at the time when you buy it. So you may be in that situation. So you may not have a tax payable at that point, but any taxes when you've got the income coming in is a tax at 15 cents in the dollar. When you get to retirement, the beauty of that when you get to retirement is the fact that once your super fund is in what we call pension phase, in that you've retired, there's no tax payable. I mean, this must be one of the greatest tax aspects that we have in Australia. When I speak to different international colleagues, nowhere has this type of opportunity from once we get to retirement. So it's really the ability of setting yourself up and looking at how you can get assets that you might have outside of super, whether it be cash or investment assets, and getting it into what is a low taxed environment now, but also a no taxed environment once you retire. And that goes for investment income once you retire, but also if you sold the property. If you sold the property day one after you retire and you're in pension phase, no capital gains tax at all. And even if you did sell the property whilst you're in accumulation, you're only still looking at 10% tax from a capital gains perspective in super. So that brings me into that capital gains tax discount. Effective is only 10% whilst you're in your actual accumulation phase. So there's no restriction on you having to hold on to that property that you might be investing in your super fund and having to hold on to it forever. If you do hold on to it till you get to retirement, no tax. But if you do actually sell it prior to that, you're only talking 10% tax from a capital gains. Relative to other asset categories, property is relatively stable and potentially low risk investment option relative to potentially some shares, depending on your risk profile and what you decide to invest in. And then also, I guess what I find is there's many other people out there like me who are quite comfortable with property and like the ability to know that you can, stand on the land and it's not going to, in a sense, evaporate like you have with share trading. So that's where I guess from a property investment perspective, you've got, it's a bit more stable, generally speaking. Obviously, no guarantees on what happens with the property market, but it can be. Also, we can look at diversification of your super portfolio. Quite a number of people have funds in managed investments. And so adding an actual business real property or a residential property in there can just kind of spread your diversification of where you're investing your assets for the future. Also, the other really great thing is assets in an SMSF are actually protected against any kind of bankruptcy, general debt recovery, etc. So it's really a great form of really kind of asset protection from that perspective as well. So I wanted to go through and then the last one, access to funds to make the investment in property. Sometimes actually you might be wanting to make an investment in get into the property market and you've got money in super, you may not have those funds outside of super. So it can be an opportunity to invest in the property market that you may not have had access to those funds to do as well. So I want to go through a few different, I call them structure options. And the reason I want to go through is that it's not as I'm going to talk about at the end, not a one size fits all. There can be different scenarios. It can also be dependent on where you're at in your business working career versus how close to retirement versus do you run a business. So I'll go through just a few different options and you might find that one or two of these is actually something that kind of resonates on your side. So there is the option of when you're looking at investing in property in your self-managed super fund, your self-managed super fund may actually just buy the property outright. If you had enough funds in your self-managed super, it buys the property and could be residential property can be purchased from third party only. So you can't purchase from yourself. But if you have a commercial property, so a business real property that you may own outside of super, could be in a family trust, could be owned personally, could be something that a relative owns, you actually can buy that as long as you've got all these other rules that come into play, must be at market value, different value, separate valuation, etc. But you can actually buy the commercial property to get it into what is a low tax, then potentially no tax environment. The SMSF will receive rental income, incurs property expense, and it will pay only 15 cents in the dollar on any net investment from that perspective. Now, the other option you can look at too, where you can actually look at potentially in-specie transfer. So what's an in-specie transfer? It means that you're actually, if you as the SMSF member, so basically you are the member of your super fund, and you actually may own a property, and it'd have to be a business real property, can't be, again, can't be the residential. But if you own, say, a factory outside of super personally, you could potentially in specie transfer it in. So transfer it into your super fund and use some of what we call the contribution caps. And this is something we can help advise you on to get that property into your super. There's no debt attached on it. And it's basically taking the property from what is now a high tax environment into a low tax and in the future, no tax environment. There is also on that situation, potentially stamp duty exemption. That is something that we often apply for. We have to say potential because it's an application. It's not just a tick the box, you satisfied the criteria, but that's a potential from that side as well. Then we have situations where you might have unrelated business partners. So if you're in business with someone else and you might decide to actually go into buy a property together to operate the business out of, you might have two super funds, or maybe you want to invest via your super fund and your business partner may want to invest via a family trust or whatever they want to invest. That doesn't matter, but you both buy units into a property unit trust. So we put the property in a unit trust there, and you'd have the borrowing with the third party lender there as well. So down at that point, and the business just pays rent to the unit trust, and then that gets distributed back to your super fund. So this is a way where you're actually able to have a borrowing in the unit trust because you've got unrelated parties. Just note that you can't do this structure if you have related parties. Now, Paul will talk a bit more about related parties. And this is where anything to do with super, you always need to get the rules checked because you will actually have to always go through an audit as part of your self-managed super fund, which many of you, if you've got a self-managed super fund now, would be aware of that. But there are some very strict rules around it. So this structure only works when you have unrelated business, unrelated parties. So, you know, not by married, family, etc. So you've got unrelated business parties there. If you were looking at a property development and just putting these as different options out there. So a super fund itself cannot actually develop property unless it owns all of the property outright. Now, very rarely are we going to have someone that's got a self-managed super fund that's got, you know, and especially with the restriction on the contributions in getting money into super now from what has been restricted over the last 10 years, very rarely we're going to have someone that's got enough spare cash sitting in their super fund to do such a development. But one of the other options, if you were looking at doing a development, is actually looking at having a unit trust being the one that purchases the land and develops, in this example, the factory. Now, with this particular situation, this unit trust just cannot have any borrowing. Cannot have any borrowing. That property that you buy cannot be used for any security to get the loan. So what we find is clients that may have actually paid off their home loan or have equity outside of their super fund, using that equity to be able to go to the lender and get a loan. The loan goes to the super fund, and then the super fund buys units, so 700 units for 700,000 to get the money into the unit trust so that the unit trust can hold the property as a clear title. So that's something we can go through if you are looking at property development. I have seen scenarios, and I'm sure Paul as an ex-auditor has seen it, where we've had people come to them and say, oh, well, I bought this block of land in my super fund and now I'm going to develop it. They've bought the block of land up here in the super fund thinking that they're going to develop it and they've got a loan on it and they actually can't do it. They can't do it. So we've had issues with that. So anytime you're wanting to do any of these types of areas, do contact, because there are some challenging requirements around some of this. So I'm going to hand over now for Paul to talk about, well, how, if you're not buying outright, you're not buying in specie, and you're not actually buying in with a business partner or looking at the development, how do we buy a property using borrowings from a SMSF perspective?
Yeah, thanks, Shannon. So SMSF borrowing actually wasn't allowed for a long time in self-managed super funds until September 2007, where they changed the laws and the rules and regulations regarding SMSFs to allow borrowing in certain limited circumstances, and it has to follow strict protocols to be allowed. Since then, it has grown quite significantly. So as of 2019, per the ATO statistics, 11% of all SMSFs have borrowings in their fund, and the average borrowing per SMSF with borrowing is 361,000 per fund. So it is absolutely a growing area. The ATO statistics, and the ATO are a little bit behind. They released their statistics a couple of years later, so that's why we're referring back to 2019. So in the 5 years to 2019, SMSF borrowing actually doubled. So the number of SMSFs that have actually have reported some borrowing to the ATO has to be reported to the ATO, by the way. The actual number of SMSFs that are reported borrowing to the ATO has actually doubled over the 5 years to 2018, I think it is, or 19. And I can only imagine since then it's increased even further from there. So it is and that's one of the reasons why we're presenting this to you today, is it's a really good opportunity that we wanted to make sure everyone is aware of. Go to the next slide, Shannon. Sorry, I can't. Yep, thank you. So just some important things to note. There's the statistics that I was just referring to. So some important things to note about SMSF borrowings is that the loans are what we call limited recourse. So the property itself, actually we'll show you in a diagram in a moment, but the property itself that you buy that's been the loan is against is actually sitting in what we call a bare trust. It's sort of like almost a sub-trust of the self-managed super fund. So that when the mortgage goes on the title of that property, the lender has recourse against that loan is just that property, not the general funds of the SMSF. Some other specifics about SMSF borrowing is it's single asset per loan. As mentioned by Shannon, there's no alterations to the property or to the investment once that borrowing is in place. You can't make significant renovations to sort of change the value of the property. So it'll be only sort of repairs and maintenance from then. Can also be higher costs in SMSF borrowings and ensuring to comply with all the relevant laws. Hard to cancel as well, hard to change as mentioned. Because you essentially, to change, you need to pay out the borrowings and sort of start the setup again, I guess. And a couple of other things that I really wanted to note here that I think are important is to one is cash flow. So this is particularly important if your fund is in pension phase or considering going into pension phase soon, that you need to be able to pay out the minimum pension requirements. So to make sure that the cash inflow to your fund is going to meet the sufficient requirements to pay out the pension payments that are required by law. This can be an area that I found clients can get into trouble, because obviously the big difference between property and shares is you can't just liquidate some of the property in order to satisfy your pension payments. So that's a really important thing to note if you're getting close to pension phase, or if you're in pension phase in your SMSF. The other item to note is the investment strategy. The ATO has been sending out letters to some SMSF owners in regard to if they have 100% or close to 100% of their funds invested in property in their SMSF. They can send the letter, but nothing is against the law. So it's not against, nothing against the law. It's not against the law to have 100% of your funds invested in property. However, it just needs to be noted on the investment strategy that we can help you prepare to make sure that satisfies all ATO requirements. If we can just go to the next slide, Shannon, please. Thank you. So this is the basic structure of a LRBA, limited recourse borrowing arrangement. So the super fund there at the top left, and the third party lender. So the money is loaned to the SMSF, and the SMSF then pays back the principals and repayments to the third party lender. The property itself is held by the bare trust as security for the lender. As you can see, the dotted line, the security for the lender, and the beneficial owner of that property in that bare trust is in fact the self-managed superannuation fund. So this is just important to understand the structure and why, we have clients that they decide that they want to do this, but you need to actually understand the structure. And there's a lot of paperwork involved, which of course we all handle and can explain to you at the time of doing, but it is important that you do have to have everything in place perfectly in order to make sure that not only that you're complying with the rules and regulations of SMSFs as administered by the ATO, but also the lender themselves will want to see that you have all this in place correctly before they lend you the money. And so that's the standard structure. Another possibility is that you can have a related party lender. This is less common than it is in the past because they've changed some of the rules and they've really tightened the requirements around the related party lender. So a related party lender, this might be where you, I think Shannon mentioned before, where you borrow against potentially your home or use other funds to then lend to the superannuation fund yourself. If you do this, there are specific requirements that what you would call is you have to have arm's length arrangements in place so that you would treat yourself as a lender as though in the same manner that a bank would expect to be treated when they're lending the money. So, for example, there's a specific ATO interest rate that is required to be repaid. The term of the loan has to meet standard market terms. You still have to comply to loan value ratios as you would with a bank. You still have to register the mortgage against yourself, against the property for yourself as the lender as well. And you still need to be maintaining repayment frequencies and satisfying all the appropriate loan agreements. So really there's a lot there in place there now that it used to be, I guess previously it used to be the easy option in some ways. Now it's really not. It's no easier than actually going to that third party lender in many respects. Plus in this case, then your borrowing capacity outside the fund can be maintained because you're lending inside the fund rather than outside to lend yourself. So I'll hand over now to Carly to discuss more about SMSF borrowing and dealing with the banks.
Thanks, Paul. Hi, guys. I'm here to talk about the actual lending side of SMSF. So as you'll see from the slide, the big four banks, ANZ, CBA, Westpac, they're no longer lending to SMSFs. They've moved out of that space. As a broker, we have 9 lenders on our panel to choose from that are offering SMSF loans. Each lender offers different rates based on property class. So there could be commercial properties or residential investment properties in metro or regional areas, and the rates will change depending on the investment class. The interest rates are usually sort of classified as business interest rates, so you won't be seeing rates, with 2s in front of them. And it all depends on the loan to value ratio. So banks will lend up to 80% in a SMSF, but the sweet spot for them is probably 70 to 80. The lower the LVR, the lower the rate. So under 60% LVR, you're looking at rates of around 3.5%. All depends on the property class, of course. There's also fees involved. So there's your legal fees, valuation fees, and these are also dependent on the property class. So if it's a commercial property, the valuation fees are a lot higher. There's also settlement fees and, of course, stamp duty. There's offsets now available in SMSF loans. So this is a bit of a game changer. So in an SMSF, you will have your cash management account. This will be used to cover off your expenses such as taxes, insurance premiums, and administration costs. So while you've got that cash buffer in your SMSF, you can actually use that as an offset. So it will offset the money against the loan. So if you have, say, a $600,000 loan and you have $100,000 in an offset account, you'll be charged interest on $500,000 rather than the full loan balance. So it's important to note that offsets don't reduce the monthly loan repayments, but rather they reduce the interest payable, and that will reduce the loan term or how long it takes to repay the loan. A clear understanding of the structure is required by the conveyancer and lender. Generally, you should be using a solicitor. All SMSF purchases need to be signed off by a solicitor, so you need to have a certificate of legal advice. that's just so that the members and directors are fully aware of their legal obligations as the guarantor of the loan. It's mandatory now for all purchases, and very few lenders will give exception for this for refinances. So what we're seeing is that most lenders will actually require solicitor sign off on a refinance just to cover off their due diligence. Next slide, please, Shannon. Okay, so what do the banks consider when lending in your SMSF? Well, the first one up is serviceability. So they'll take into account the contributions going into the fund. So SG contributions, non-concessional, concessional contributions. They'll also look at the rental income. They'll take into account the loan to value ratio. So some lenders will lend up to 80%. Generally, it's 70 to 80. And as I said before, the lower the LVR, the lower the rates. They'll also look at commercial property. So if the related tenant or all of the above plus the business performance, so they'll take into account all the financials. And you have to have professional financial advice with SMSF. So that's where Shannon and Bianca come into it, and they'll provide you the advice. They'll look at the modelling, and they'll include a 2% interest rate stress test to make sure that the fund can actually afford the property and the loan associated with it. Also, what comes along with SMSF lending is a stack of paperwork. So this is where I come in to try and streamline things. I work with Shannon. So we have all the financials at the office, so I can look over those and provide them to the bank. But there is so much paperwork that we need to provide. So just some examples of that, certified SMSF trust deeds, certified SMSF bare trust deeds, ASIC registration certificates, accountants' letters to confirm the running costs, 2 years, generally 2 years financial statements if self-employed, 2 years financials for the fund. And then there's also the rental statements and the real estate rental appraisals. So a stack of paperwork, but that's where I step in to help streamline things.
Right.
Over to you, Paul.
It certainly is a stack of paperwork. You should see the big, and they actually print, a lot of the lenders print it all up, and that's the crazy part about a lot of it. So some of the types of properties an SMSF can invest in. So what are some of those types? Now, one of the big things that I say this, whether it's an SMSF or not an SMSF, is really to be focusing on whatever you invest in from a property perspective. Just remember that negative gearing without capital growth is just social housing. The number of times people have said to me, oh, I really want to buy this property. It's great for negative gearing. And I look at it from a capital growth. If you're not going to get the capital growth, you're really not going to get the benefit. And it's true outside of super, but even more important inside of super, because ultimately what we're wanting is to see the capital growth in your SMSF, so that when you get to retirement and you've got rental income coming in, you're going to be living off this passive income. Or you sell the asset at retirement, sell it, get the capital gain, all tax free, and invest in maybe something. Maybe you don't want to invest in property at that point, and at that point you want to put it into managed accounts or some other types of investments. So what can we invest in? So we've decided we're going to invest in property with the SMSF. We're happy with the loan side of it. What type of property can we actually invest in? So you can invest in vacant land, residential or commercial. Go back to my note though before, that if you are wanting to develop that land, you're going to need to put that into a unit trust and structure it that way. But you definitely can purchase vacant land, unless you've got a squillion of dollars in your SMSF and you don't need to borrow, then it's no problem. But most of us are not in that situation. You can, your SMSF can buy residential houses, apartments, units, commercial properties, so factories, medical, office spaces. And it can be new, they can be new properties, established or off the plan. At the end of the day, it all comes down to when you're buying or investing anything in a self-managed super fund, it has to come down that it meets what we call the sole purpose test. The sole purpose of your self-managed super fund is to help basically fund your retirement. So as long as you're satisfying that sole purpose test, you are going to be able to invest in that. Hey, we've got super funds that, you know, are investing in Bitcoin. The point is they're investing in Bitcoin because that's for their ultimate overall outcome. So there's no restrictions on what you can invest in generally when it comes to with property. There are some restrictions with some other assets like outside of property, but just be aware that it must be to satisfy the sole purpose test of actually building up for your retirement. Now, when you're wanting to invest in property, that's when we start to get the questions about related parties. So I'm going to get Paul to step in and just talk about the alarm bells that can come up with related party if not done correctly.
Pardon me. Yes, thanks, Shannon. So basically, there's a few things I wanted to touch on here, and the first is that for those that haven't had an SMSF, the audit requirements are quite strenuous. So you need to be able to provide advice and documentations for every transaction that you do inside an SMSF. That's something that we help our clients with on a day-to-day basis. So it is something that can be done and is manageable, but it is important to know that your super fund will be audited every single year. If the auditor does find something wrong, the auditor then will most likely report that to the ATO, and that's when the ATO can step in and start imposing what can be some pretty hefty penalties on the trustees and also on the super fund itself. So we really want to make sure that we follow the rules with super funds because it can become quite costly if something goes wrong. So in dealing with related parties, essentially in terms of residential properties, it's just a no. We don't deal with related parties with residential properties. So I believe, Shannon, we can't buy from a related party even.
Can't sell.
We can't sell to a related party.
Yep.
We certainly can't rent. So that even might be so. For example, a residential property, and you might be in the Gold Coast or something, or you buy an apartment. That's fine. Have that in your super fund, but you can't have yourself or friends stay there. Even if it is at market rates, you still can't have that. It's just not allowed in a residential property. That being said, for commercial properties, you can lease to a related party. So that is allowed under for commercial property only. You need to pay market rent though. So we talk about in terms of related parties situations where you are allowed to deal with a related party, then you're going to have to deal with what we call an arm's length basis. So you're going to have to deal with them in terms as you would if somebody who you didn't know at all. So you're going to have to pay market rent. And in an audit situation, the auditor is going to ask you to substantiate how you came up with that market rent. Generally, we do that by providing advice from a real estate agent to say, if this property was to come on the market now, we think the market rent would be X for this year. You must also have a proper lease. So a legally enforceable lease that's signed by both parties, which again might be yourself, but it has to be a proper lease in place for that. You do get a tax deduction for paying rent to yourself, which is nice. So it is taxed as income in the fund, but if you look at, say, if you're in a company where you get a tax deduction at the 26% interest rate, and in SMSF, you're being taxed at 15% of your profits. So there is a real good tax break there. And again, you're paying, a lot of people put it this way, you're paying rent to somebody, you may as well pay rent to yourself and to contribute to your own wealth in that scenario. Again, dealing with related parties, the market purchase or the sale value, if you're purchasing or selling to a related party with commercial property, it must be at the market rate, and you need to be able to substantiate that with an auditor. So it's really important that everything you do must be within that arm's length, even so much as frequency of payments is another one. So you can't just go, oh, I'll catch up later next month. The auditor actually wants to see that you're paying each month, because you wouldn't let a third party get away with, oh, I won't pay you rent for a couple of months. So you can't let yourself get away with that, for example. Obviously, in recent times under COVID, there has been certain exceptions to that, but I'm talking about in sort of normal times and normal rules, that wouldn't apply. Thanks, Shannon.
So when it comes down to investing in property in an SMSF, I guess the one great thing about it really is it's not a one size does not fit all, but it actually means you can adapt, I guess, to your certain circumstances from the perspective, obviously, at all times remaining within the parameters of the Superannuation Act. But what I mean by this is it's not just that investing in property in an SMSF is only for business owners. It's not just that it's only for those that want to invest in commercial property. It can be adapted for so many different, I guess you could say, family groups or your personal situation, which I think is kind of the great way about it. And we're seeing more and more employee or executives who are setting up a self-managed super fund that over time have built up wealth in a retail super fund. That's what we call all the others, so to speak, are setting up a self-managed super fund and wanting to invest in property in their self-managed super fund, and they're not running a business. So it's not like they're buying a property to put their own business put the business property into a super fund and pay their own rent. So there's a really a variety of ways to do it. One way, actually, and I'll go through this investment strategy in a second, but one thing that's really interesting that you actually can do is you actually can buy the property that you may ultimately want to retire to. Now, the reason I say that, and I've got an example, actually I've got a few examples of clients that have actually purchased the property they want to retire to, and it's a residential property, so they've bought it from a third party, it's rented to third parties, and even using Paul's example on the Queensland, maybe you want to retire to Noosa. You're buying a property up in Noosa that's something that you're not going to be able to, in a sense, use because you're buying it in your self-managed super fund. But once you get to retirement, and this is where the financial planning aspect comes in, and when we're working with clients, we kind of financially model it out, but also plan out what's our end game, what's retirement look like, how are we going to enjoy retirement, is you might buy that property you want to retire in that you can't afford to buy today outside of super, you don't have the funds there, and you're not moving to Noosa yet until you get to the retirement. So you might buy that property today in your self-managed super fund, and you may rent it out to third parties because it's a related party, you cannot rent it out. It's a residential, you cannot rent it out to yourself. When you get to retirement, and this is the beauty of it, you get to retirement, that asset at that point, you can actually take, at that point, once you get to retirement, you can take all the funds out of your super fund, maybe all of it, maybe not all of it, because you still want to have funds to be living on and getting pension. But you can take a lump sum out of your super fund, or you can take a pension or a combination of both. Now that lump sum may actually be, look, instead of taking cash, I'll take the property, or you may sell it at that point and you're already in the market up there and then buy something else. So that's kind of one of these side strategies that when I'm looking at with clients, we might be doing 10, 15 year planning where they're actually like, well, that's the retirement place I want. How can I work that out from a strategic perspective? But just to have a look at, well, what is your investment strategy? Just to give you an example, and this goes back to a bit where we talked about the borrowing, that Paul went through the different structuring of the borrowing, and Carly talked about the opportunities available. If you came to me and maybe you've rolled over your super and you've both rolled it over, and actually interesting, a super fund can actually have, well, it used to be only 4 members. Now it can have up to 6 members, which is great because you can have a whole, in a sense, family super fund. Now, there are different aspects you need to think about from an investment perspective, and where are people at, who's at accumulation phase, who's close to retirement, are we going to have the funds to retirement, what's everyone's risk profiles. But the opportunity here is really pooling together some of these funds to be able to do some great wealth building. So let's just say you came to me and you said, I've got 600,000 in cash in my super and I want to go and invest in property. Now, the first thing that I'm going to say to you, and remembering that I am a little addicted to property investments, so I might be, biased on that, and I can never give you recommendations of what properties to buy as far as, you should buy that one down the road there or et cetera, because I'm not a real estate agent, but I can certainly crunch the numbers for you. But I'd be actually asking you the question of, well, what's your long-term investment strategy? So take the blinkers off. We're not just looking today. You've got 600,000 in cash. And as Paul talked earlier, when you borrow, you can only borrow to buy a single asset. And when you've actually got that asset, that property, if you've actually owning this factory outright, now if this was outside of super, you would use the equity in that property to buy something else and then to buy something else. We can't do that in super. Super is literally like putting your blinkers on for each property. Each property, each loan is just, blinkers on, and it stays to itself. So this is where if you actually bought one property worth 600,000, so you had no debt, and let's just say over the next, 5 years, you keep making the super contributions. There's 2 of you making contributions. Where are you going to be in 5 years? Well, the purchase for the factory of 600,000, let's just say it's worth 850,000. That's great. So you've got an asset of 850,000. You've got the cash that's built up. Now, I'm going to give you another option, because remembering if you've got time on your side, let's just say you've got 10 years, 15 years till retirement. What about instead of doing that? And I've got a lot of clients who do also get a little addicted to property in their super fund. I'll give you that much. That maybe in year 1, they've bought that factory for 600,000. They've borrowed, so they've got 390,000 of debt. They've invested the balance in the cash, or potentially they've done an offset account. So now we've got this offset account available. That's a really great option as well. Depending on what we're looking at investing in, I'd be wanting to make more interest income than the interest that we're saving. So that's something that we'll look at, but you've definitely got those options. Let's just say year 2, they decide, we'll buy an off the plan apartment, because now we've got a commercial property, then we've got a residential, and we're saying it's 600, and then they're borrowing as well, and they've got then the cash just invested as well, and maybe managed account or something. Year 5, we've built up cash as we've been contributing into super. We take it out of the investment, and now we buy a factory worth 700,000 with, say, 455 of debt. What you can see here, and I guess what I'm wanting to highlight, is the opportunity that when you've got a situation, remembering, as Paul said, with a super fund, we've got to satisfy audit requirements. You've got to basically, it's not your money yet until you retire. It's not your asset yet, and it's kind of in this entity to the side. Now, if you've got something that you can actually build on, at the end of 5 years, what would this $600,000 property now be worth? What would the end of year 2, what would that property now at the end of year 5 be worth? And what would this new one be worth? And how are your debts going down? So being able to actually use borrowing to your benefit, and this is why you could say investment in property for self-managed super funds and the increase in the number of SMSFs borrowing has doubled in 5 years. It's doubled because now you don't have to, before the rules of having debt, you could only buy one property and you just have to wait till you saved up the next 600,000. In that period of time, you could have bought 3 properties. So you've got 3 properties in the market that are going into capital growth. You're paying down the loans. And so that's where it can be that benefit. Now, I've got a number of clients that have done this exact scenario, and their theory is that in 10, 15 years time, when it is that they get to retirement, they're hoping that they'll sell, say, one property, that the sale of that one at that point, and remembering they've gone into retirement phase, so it's now 100% tax-free profit that they've just made. Let's just say in year 15, in 10 years time, they sell the $700,000 factory for, $2 million. Let's just put a figure out there. What their goal is selling that one to pay off the remaining debts of the others, and then having 2 properties that they own that gives rental income, and that's what they're retiring on. And again, because it's in super, and it's a pension, it's tax-free. Now, one thing not to get this wrong, because I hear this a lot of times, a number of people that say to me, oh, it's okay, once I retire, I don't pay tax anymore. No, actually, you do still pay tax. You only get it tax-free if it's coming from a super fund. So if you owned all of these properties outside of super, you're paying tax today, and when you retire, you're still paying the same tax. You may just not have your business income as well, and therefore you're on a different tax rate, but you're still paying tax on that as well. So that's something we can look at. We do a lot of financial modeling on this with clients to be actually able to say, look, your first factory purchase is going to be paid off, and as Carly mentioned on the loans, the loans now used to be really short loans that the super funds they give super funds. Now we're seeing, is it, Carly, 15 years, 20-year loans that we're being able to see on a super. So you can actually get a loan for the rest of, I guess you could say, your working life in your super fund. And then when you're looking at rental income, being able to kind of cover that as well. So there's some really fun strategies that you can kind of look at in trying to build up your overall wealth. Because what you're trying to do from a super perspective is build up your asset base so that when you get to retirement, that is the asset that you're then earning passive income. So the higher you can get your asset base up to, generally speaking, if we look at rental return, that's going to increase the amount of rent and passive income that you're getting at that point. So that really nicely goes into that strategy. So some of the investment, make sure when you're thinking about, and what is it right for you? And that's, I do like the fact that actually you can cater for everyone's different, different personal situations, even your different appetite to different properties. I've got some clients who will only buy commercial. I've got some who will only buy residential, but it's really great that you can actually adapt to that. Have a look what type of property, what the structure, would you have it in your SMSF? Are you going to buy it outright? Do you and spread the cash to buy more? What's your appetite to risk? What's your future cash flows? Because the other thing that we want to make sure, especially if you're getting close to retirement, we don't want to have these assets that you get to retirement and there's no cash because you've still got maybe loans to be able to actually give you that pension income. So that's something that we go through and financially model. Make sure you understand the structure, the tax, the risks, and the strategy. Now, I know that none of you are probably going to love accounting, SMSFs, and tax and everything like that like we do, but we do try and help you understand the structure once you've got it set up. As Carly said, there's heaps of paperwork with the borrowing, but once you've got it there, and if you can understand that, at least then you can be able to tick, it should be able to tick on at that point, but we give you some good strong parameters to make sure that you don't kind of cross the line, keeping a copy of every invoice that you've got, making sure that you've got that market, especially if you're renting to yourself from a commercial property, you've got that market appraisal to support the rent and that. So we can certainly happy to help you all around those. Property should be for the long term. We all would love to find that bargain property down the road that we flip straight away, but I don't know, if you find one, let me know. I don't think there's that much of a, I don't know where the property bargains are these days. I don't think they're really around, but it should be from a long term, and property is a growth asset that is something that you would be seeing that over a period of time you'd be expecting, but do get advice from it, because the number of times we have people after they've done it, or, I've got one actually, Paul's going to help me clean up this mess. Actually, we've got a new client that's just come in that bought a property in their SMSF. They bought it from a related party. They did a deal and got it cheaper, and it's the ATO's come in. They've got a contravention. What it means with the ATO, they're lucky this was commercial property. If it was residential, it would have been what we called a tainted property, and they would have been made to sell it within, I think the timing is at 90 days or 120 days or something like that, Paul, that the ATO mandate that you actually have to sell a property. Lucky it's commercial, so we can actually fix it. It's going to cost them a lot of time, pain and legal work to get it fixed, but they didn't get advice before going off and doing it. So if you do need any help, yell out tax, obviously tax and business advisory, financial planning, broking now, so that basically Carly can be harassing myself and Bianca and not actually harassing you for a lot of the information. So trying to make that as easy as possible and really helping you on the on getting that framework as well. So we can help you on all of those areas. I'll just put out there some questions. We have got some questions coming through. Did you want to go through?
Yeah, I'll go through those and ask them to you, Shannon, if you like. So one question, can we get a copy of the slides? I believe all attendees will get a copy of the slides and the recording tomorrow, probably. Yep. So another question, wife and I own an apartment and we want to set up an SMSF to get the SMSF to purchase the property from us. From what we have said, it looks like we can't do because it's a residential property. However, another financial advisor said I can do it, so I'm confused.
Yeah, so yeah, definitely you can't with a related party, with an apartment. It's residential.
Yep.
Yeah, the rules are actually really strict, and they actually say that you actually can't buy related party unless it's business real property, and it's very clear. So I'm very surprised the other advisor has actually said that, because I guess it's nearly down to, SMSF 101 that you actually can't buy from a related party unless it's, commercial, and you've got, and it's called, and when we say commercial, it's called business real property. That's the challenge on that side. So yeah, I definitely go back and don't do that before you get the legal advice on it, because it would, If you did do it, it would instantly taint it and you'd have to sell it and get it out, and you'll have stamp duty and all of those things.
This one might be for Carly. Is the offset money from the lender guaranteed by the government if the lender goes under? For example, a 250 guaranteed from the government if you have a term deposit with the Big Four.
Okay, yeah. So the government actually backs $250,000 across all banking financial institutions. So yes, it is backed by the government. The limit is applied to the whole fund, not each individual member.
Okay, thank you.
Yeah, no, that's good.
And that's all the questions I think we had, Jen.
Well, maybe we've asked a lot of the questions. That's
Hopefully.
good.
People know where to find us though. If they
and if you're thinking about implementing an SMSF and you're not sure if that's right for you, we did do a webinar on this a few months ago. So if you don't have an SMSF and you're thinking about whether it's the right strategy for you, it may or may not be the right strategy. It really comes down to what you want to do. There is going to be more paperwork. If you have an obsession for property and you want to invest in real property, then you would need an SMSF because you can't do that with a retail fund. But if you go to our website, smartfinancialplanning.com.au/learning centre, or if you go to our YouTube channel, this is the webinar, SMSF, is it the right strategy for you? We went through what you need to consider when you're looking at that. And obviously we're happy to chat to you about that. We do have another upcoming webinar in relation to our financial and wealth building on planning for your retirement. And this, I guess all of these kind of nicely dovetail into planning for your retirement. I like to always say that it's not about saying, when we have clients that come in and say, look, I've got 5 years till retirement, I want to get, planning. Absolutely, we can help them. But gee, when we have people that come in and we've got 10 years or 15 years, I love it. It's like a fast kind of stroll to retirement that we can plan it out over that time and not have that last minute sprint to try and build it up. And because what we're often trying to look at with retirement is really getting to that from a tax perspective, but trying to build up that asset base that you've got in super, whether it be a self-managed super fund or a retail super fund, so that you end up getting that tax-free environment. But you mustn't forget that period between when you're actually able to access your super and when you might choose to actually finish work. I have some people say, like, I want to have the choice to finish working at, say, 55, and you're not going to be able to access super to 60. What do you do in those 5 years? So it's a balancing act. You want to get enough into super so that we've got a plan for retirement, but you also need to enjoy life today as well. We do, if you go to our YouTube channel, you will see a lot of our webinars that we've conducted. We've put those up. Also on the financial planning side, I've actually done quite a number of short little videos just to explain different aspects, whether it be around insurances, investments, some of the questions, I guess, that come to us. And I've just, every time I get a question, I think, well, I'll just record a quick little video on that. And then just to introduce our leadership team, obviously myself, you've met Paul on this webinar, and many of you have also met Daniel as well. So if you have any questions, feel free to reach out. If you want to give Carly more paperwork for her desk and get her to assist with an SMSF, feel free to reach out and she can do that. Or if you are looking at setting up an SMSF, just remember that with an SMSF, it is considered a financial product. It's not something, and this has been the rule since 2016, it's not something that you can ring up your accountant and say, should I set up an SMSF? Can you set me up an SMSF? You now actually need to go through a financial advice process. And the reason for that is really to protect, I guess, the consumers, because there's been a lot of situations out there that people have been set up in those structures. So it is something that we do need to go through the financial advice process to go through and that. But feel free to let us know if you have any further questions that come up as a result, or if we can help, or if you just want to chat about property, because we all love chatting about property in SMSF, do reach out to us. But thanks very much for coming along today.
Thanks, everyone.
Great. Thank you.
Guys.
Thanks.